Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep. Got the B team again. Dan and his large brain are out taking care of something. So this is going to be a completely market-focused podcast today. Got myself, you got Connor Bates, Ted Zhang, and Todd Thomas. And quite an interesting week in the markets. And really, things got more interesting after FOMC last Wednesday. I'm going to get right into the charts. The theme for this show is going to be the quick and the dead. That has some biblical references to that, but when I think of the saying, I think about the wild, wild west, two guys in a gunfight, and we pretty much know the one that's going to survive. The guy that's the quickest and the guy that's slower is going to be dead. And that's going to carry over to the market by showing some recent names that had very strong run-ups and then turned around and gave substantial portions of those back in just a number of days. And it speaks to one of the key sell rules that we use here at Revere, that being offensive selling. We make a point because we know throughout market history when stocks get on extended runs to the upside, it's going to end, and it usually ends badly. The question obviously always is, what are the signs for that happening? We talk about climax tops at times. We talk about reversal candles. But I'm going to bring up about 5 or 6 stocks before I turn it over to the fellas and they do their individual segments. But let's start with where we are in the S&P 500 right now. So I'm going to get out my line pen, and basically 13 days ago, we broke out of a consolidation on the S&P 500 and started to work our way to the upside. Nice, smooth. Then you see this candle. This was Wednesday, the 17th of September. That was FOMC. There was a big intraday shakeout, but the end result on Thursday and Friday after that week ended up with a bullish resolution to the upside. We talk all the time about inflection points, and they're very clear on the chart. The question is what happens after one of these inflection points takes place. So I've got 4 of them drawn out here. There's actually a 5th one that happened yesterday. So let's just take a step back. Late July, we had a big negative 2-day reversal below the 21-day moving average, but the market immediately rebounded and made it to highs. We had a gentle pullback after that. We're at mid-August now, a big up candle, going sideways for a little while, and then late August, another harsh pullback below the 21-day moving average, but we closed right on the 21 by the end of the day. That was a shakeout. We proceeded to go higher. The breakout that I talked about 13 sessions ago, working our way higher. FOMC, the middle of last week, a shakeout below the 8 EMA, working our way higher. But now this pullback over the last couple of days, while it looks somewhat normal on the S&P 500, it's been a lot harder on individual growth names. And I'm going to show some of those charts in a moment, as I mentioned. But yesterday was day 3 of the pullback, 3rd day in a row of underperformance by leading stocks. We're seeing some underperformance now on day 4 of some leading names. But what we're seeing is no pain in the S&P 500 because and this is a tenet of what we do at Revere, we keep a core position in the S&P 500, and it's for market sessions like what happened this week, where you see a lot of rotation out of growth names and into value names, but that core position that we have in the S&P 500 catches all that rotation. The money's not leaving the market, it's just rotating around. But it's coming out of certain sectors, going into other sectors. All of those sectors, they're obviously weighted differently, but they're all inside the S&P 500. So when money comes out of growth, it goes into value. It smooths the equity curve of the S&P 500 as well as our clients' equity curves. Because if you're loaded up with growth stocks and you take a tremendous hit, sometimes you chase to get in these names, and 20+% pullbacks in a handful of days, it can be extremely frustrating. So what we're looking at now on the S&P is this last inflection point was a shakeout to the 21-day moving average. We saw it on the NASDAQ 100, and basically it means that the lows of that day are critical. And if the lows of that day get breached, we're going to take fairly significant action in our portfolios. We actually have been lightening up quite a bit over the last week because our stops are taking us out of the market. We're also noticing that recent buys in growth names haven't made much traction. And again, it's a function of the market just rotating from growth names into value names. Let's take a look at this chart that I have here. It's basically a quick and a dead chart. It's got 7 names that were market leaders to varying degrees. They all hit their highs either on 9/18 or 9/22 and then proceeded to pull back, made their lows either yesterday, again, that's the inflection point, or in the case of IREN today. So we got their high price in the date, their low price in the date, and this is very clear how fast some of these things can deteriorate. I'm going to go through these one by one. But ALAB, 7 days, a 27% pullback. Credo, 7 days, a 22% pullback. Reddit, 7 days, 21%. BE, 4 days, 29%. Tempest AI, 4 days, 24%. IREN, 2 days, 19.6%. The quick and the dead. If you're not paying attention and you chase these late, if you got in early from a solid breakout, a solid pattern, you're giving back profits. But it's one of the reasons why we focus on the 8-day moving average during strong run-ups the way that we do. The strongest stocks and the strongest markets tend to trend higher along this faint purple line here. That's the 8-day moving average. If they break below it, our next level down that we look to is the 21. But if we're below the 8 on a harsh break after a strong run up, we're not holding a full position all the way down to the 21-day moving average. And the reason is that chart that I just showed you. Do we want to really see ALAB drop 27%? Do we really want to see, let's go to Credo. Credo topped, nice run up, riding the 8 EMA, nice tight consolidation and a breakout above it. But again, we talk all the time about from failed moves can come fast moves. Now this broke out on the 18th, but 2 days later had an immediate hard reversal. And this is what we've seen a lot with growth names this week. Next one up is Reddit. I got stopped out of my last piece of this with a break below the 21-day moving average. Beautiful run up after an earnings gap, normal consolidation, started another run up. This is a topping candle. It's called an evening star. After a run up, a negative reversal. It's confirmed by a break of the prior day halfway through, and you can see what Reddit did, down 21% in 7 days. Next up is BE. Beautiful run up. Giving back profits hurts. If you chase this, though, and you got into it late, again, if you use the 8-day moving average as your break here, you didn't get hurt that bad. But 4 days, 29% on BE. Kind of went parabolic at the end there, as you can see. Ted and Connor cranked out some very nice profits in turbotection on some of these names, took some profits on the way up. I held a couple of them, didn't do nearly as well as they did. Here's Tempest AI, nice breakout, but look at this topping candle. This was a news failure as well. We talked about this in the morning call. It was gapping up on an approval, but if you get earnings failures like this, that's another reason to pull the trigger and get out of it. 4 days down, 24% lower, breaking the 80 EMA, breaking the 21 EMA. And then if you break the 21 and it starts to roll over, what you want to watch is this, if that 21-day moving average acts as resistance if the stock tries to make a move higher. And finally, IREN, beautiful move up again, came near the 50 area, but not quite to there. 2 days later, you're down 19.6% off the top. The quick and the dead, sitting like a deer in the headlights. The easiest thing to do is to just sell a piece. And I do this all the time. If you're sitting there and your level's getting broken, you wonder if it's just a temporary thing intraday, just sell a piece of it. Sell 20%, 25%, a third. I like to do sells in tranches of 25% to 30%, 33%. But if it continues to go lower, you just start taking more off. And if it sets up again, and that's really what these stocks are looking like they need, is better setup. So bases, what goes up must come down. And sometimes that what comes down certainly comes down harder than we think. One, switching gears to when it's good not to be quick, and that's with the account assimilation process that we do at Revere. We recently had a ton of new money flow into the company. A lot of people seeing the process that we go through, participate during uptrends, get out of the way during downtrends. It's a common sense approach. It allows you to sleep well at night, not worrying that the market is going to destroy your plan, your retirement plan, your nest egg. But one thing that we do commit to and clients are concerned about all the time, and we do it slowly, and that's new client assimilation. If we get somebody comes in with, say, a $200,000 account, we are not going to plunge that immediately into the market. A typical scenario that you would see is the first day we would move 10% into the S&P 500 if it was in a bullish position. The second day, another 10%, or the third day, another 10%. But normally the first position that we fill up with assimilation is SPLG. That's our S&P 500 core position that we hold. We want to get it up to around 30%, and we'll do that fairly quickly. But all that gives you is a third of the risk of the overall market. So while it might seem like that's going in pretty quickly, it's not a leveraged ETF. It's a single ETF. And as I said, if you hit a situation where the money is flowing out of growth names and into value names, the S&P 500 catches all of that rotation. And then as new buys are made, new clients will get those buys, but those buys we're very risk managed in here. So at Revere. So the new buys have minimal risk as is, because they're typically starter positions. If they continue to work, great. If they don't, we're out with a paper cut. We're looking at this with new clients as a marathon and not a sprint. It sometimes could be frustrating if the market is running up strongly and we're not fully in it. But on the other side, if you've got a harsh pullback in the market, especially in some of the names that we're in, we don't want the client to get hit with the 2x4 right out of the gate and ruin our relationship with them. So quick in the dead. It's good to be quick when things are turning in the market. We detail our thoughts on the market every night on video. We've mentioned every night the market weakness that we've been seeing in the leaders this week. You've seen us take preventive action in our videos to book gains or to cut losses short. An example of a one-day hold, for example, GEV. This looked great, setting up very nicely, move above the 8, 21 and 50-day moving averages. But yesterday, the AI data center names took a hit. I stopped GEV out after 1 day because it broke that level. We have no problem taking small losses. We'll give back some gains off of the top from stocks that made big moves until they break the 8 or the 21-day moving average. But it's a partial position that we're selling, not necessarily giving back all of the gains that we made on the way up. So that's where we are with the market. Quick to pull the trigger and take gains out, slow to assimilate new clients coming in. It's a marathon, not a sprint there. So what we're looking at the S&P 500, as I mentioned right now, is this inflection point where the S&P 500, also the NASDAQ 100, and the Russell 2000, which had been the leading index over the last 5 weeks. You can see that on the relative strength line. All three of those bounced at and held at the 21-day moving average. So the lows of Thursday are our latest inflection point, a critical level that we're watching. We're also watching how individual names behave against the low of that same day with their inflection point. You can see the Russell with this is really an evening star candle as well that it put in before it had the gap down on Thursday. So we're trapped now between, not really trapped, but the reference point that we're watching is resistance at the recent highs for the indexes and the 21-day moving average. This is the keys that we're highlighting. These are the keys that we're highlighting in every night on our videos as part of the tail of the tape. We talk about the keys coming into the day and the keys for the next day, what we'll be watching. Those keys get boring at times. Sometimes they're the same thing, but it's the outcome against the keys that dictates the importance. So if for a while, for weeks, we were mentioning the 8 EMA because the indexes were holding that level, especially the Russell right here. Well, it broke the 8 yesterday. That's feedback. We ended up trimming some of our TNA position. In some portfolios, it was closed completely, like Rotection. In Turbo, just a trim from some of the profits that they've booked up. But the S&P 500, again, that is the level that we're watching for the latest inflection point. So that's it. Oh, I do want to notice the weakness in the equal weight S&P 500. Yesterday, it not only broke the 21, but came down to the 50-day moving average, undercut it intraday. Nice bounce today, however, on the equal weight. And again, this is because as I look at my quote screen, most of the growth names are red while the value sectors are positive, and that's money rotating inside the S&P 500, getting this back again. It's 21-day back above its 21-day moving average. That's always good to see. The mid-cap index normally looks like the RSP. It did the same thing yesterday, broke the 21, bounced at the 50-day moving average, but having a good day today, up 0.8%, regaining that 21-day moving average, and that's what we want. All of our indexes configured above there, ideally above the 8, above the 21, above the 50, and above the 200-day moving average. Anybody that's familiar with our videos knows that that's the trend gauge that we post during every video, and it's not just a pretty picture. It actually dictates what's going on in the market and dictates how we're being positioned for clients. So let's take it over to the fellas, and I'm going to start out with Connor. And there's MicroStrategy, a stock that has gotten a lot of attention as a leveraged Bitcoin play. However, Michael Saylor, the CEO, they recently started treating it as a Bitcoin Treasury and putting several flavors of preferred stocks out with big yields to attract money. But how's that turning out for MicroStrategy, Connor? Let's turn it over to you. I'm going to bring up a chart of MicroStrategy, and not so good here. Take it away.
Yeah, no. When I look at this chart, it makes me think of that quote, all good things come to an end, because in 2024, MSTR was, one of our better trades for clients. throughout the year, and it was an amazing stock. And this just shows how we don't hold biases, but um, the stock has been doing absolutely nothing for the last year, and it's actually breaking down. So I wanted to talk about why we shorted it in TurboTaction, what we're seeing, and kind of our thoughts. So basically, and to preface first is, um, shorts can help a lot as well when the market's choppy because it acts as a hedge, and they can also act as a directional trade as well. And especially with all the influx of all these two times ETFs to the long side and the short side, we don't short individual stocks at Revere. This makes it it gives us access to a lot more opportunities. But basically, when you're looking at this chart, it checked every box for a perfect short. The number one is prior big move. In 2024, the stock went on an absolutely unbelievable run. It was outperforming Bitcoin by a wide margin, and that's why people liked it. You basically were getting an exposure to two times Bitcoin, and it traded awesome. If Bitcoin was up 5%, MSTR was going to be up 10 to 15%. So people definitely exploited that, and you can see it had just a huge run. And then if you flip back to the daily, then it had that climax top in September of 2024. And history always suggests that when a stock has a true climatic top, typically that is the top for quite some time. We did tons of videos on the characteristics of this climax top in different podcasts. But again, it fit every piece criteria for what a climactic top looks like: highest volume ever, third day gap in a row, just max euphoria. And after that day, price has never even came close to that level. And in How to Make Money Shorting Stocks by William O'Neill is a fantastic book. And another criteria is that you see multiple failed rally attempts above the 50-day moving average. And you can see it's September now as well. So a year later from that high, this price has been going sideways. It's been doing absolutely nothing. And you can see it's had multiple failed rally attempts above the 50-day moving average. Every time it looked like it potentially was breaking out, it failed. And again, throughout this period, it's been showing huge relative weakness versus Bitcoin, right? We got the Bitcoin breakout, a month or 2 months ago. And if Bitcoin's breaking out, why is the stock still well below off the highs? And again, that was another reason that it was just screaming relative weakness. And then as you can see, it's really started to show more relative weakness versus Bitcoin as of late. And now it's below the 200-day moving average. And that 50-day moving average is looking to cross below the 200-day moving average as well. In stock market terms, that's called a death cross. Just if the 50-day moving average is below the 200-day moving average, that is absolutely something you do not want to be long, and typically is a longer term trend signal that this is really entering potentially a secular downtrend. So that looks like it's going to cross within the coming days. And then on September 24th is when we took the short. And again, with all the new products that these companies made, we used MSTZ. Again, Don doesn't have to show that because we traded off the underlying. But that's the 2 times short ETF, and you can see we shorted it that day. Now it's breaking lower out of the shelf, and now it's just putting in a tight inside day. So we'll see if this continues lower in the coming weeks. And again, another key indication is look at that relative strength line. It's just going down every time prices tried to rally. It's got rejected at the 21 EMA with the relative strength line. I did a segment the other week on using that, and that definitely works for shorts too. It's just inverse. If a stock in an uptrend pulls back and that RS line touches the 21 EMA, that could be an opportunity. And just like vice versa on the short side, RS line tried to get back above that 21 EMA and got rejected. And if you go to the weekly chart as well, this has all the characteristics of a stock entering a stage 4 downtrend, below the 10, 20, 30, 40 week moving average. 12 months since that high. Again, the optimal time to short a stock is 6 to 12 months after a high. Everyone wants to catch the top, but that's just not what we care about. We want the optimal spot to get in with the least frustration, and that typically occurs 6 to 12 months after a high. And another thing is, you can see on this weekly, this had a 3 weeks tight below all declining moving averages on the weekly. And again, uh, that's kind of a sign of distribution per se, because on the flip side, a stock that puts in a 3 weeks tight on to the upside, that typically tends to be an ad spot, and vice versa on the downside, 3 weeks tight below all key moving averages, and it's starting to break lower out of that shelf right now. So again, at Revere, we're always looking for these opportunities. One, this is treated as a directional trade like anything else, but again, it acts as a great hedge as well. And with the new products, there's a lot more opportunities out there. And yeah, so we'll see how this plays out. Obviously, with shorts, a little bit quicker to take profits, and it's a little bit different than a long. But again, this one's working for now, and kind of had all the characteristics of a really nice short setup.
Excellent job, Connor. We've been talking about this for months in-house. You can see the failed breakout back in July. From failed moves come fast moves, and that's what we're seeing here. Great identification on this latest move up into the 200-day moving average and fail multiple times, trying to get back above the 21, couldn't do it. Great starter position, and then the gap down allowed you to add to the position. Awesome job managing that in TurboTection. All right. MicroStrategy MSTZ is the ticker that we're using. And as Connor said, very important, we're not trading this off the MSTZ chart. For one reason, that's what it looks like. For another reason, you never go by the chart of the underlying. You go by the chart, or you always go by the chart of the underlying, not by the chart of the derivative. This is MSTZ is a derivative of MicroStrategy. We're going to turn it over to Todd now. He's got 3 stocks that he's going to discuss. Todd, take it away.
Thank you, Don. Right around 1999, there was a movie that came out called Blast from the Past. Right around the time Ted and Connor were born, I believe. Right, Don?
Yeah, I think that is right.
Anyhow, 2 of these names I'm going to call Blast from the Past because they're still below their 1999 highs. And one is still below multi-year highs. But in my monthly scan, they've come up as being outstanding winners this month, and they could be in new uptrends. And the first one I'm going to talk about is Intel. And let's just start off with a monthly to see the perspective of where this stock's been and what it's been doing for the last 25 years, which is not much. But you can see this month and last month, we had 2 huge volume months in the stock. And if we go to the weekly chart, we can see we have a new trend developing here. Now, there's 2 notable things that have happened with Intel. In August, the government took a 10% stake, a private passive stake in the company to ensure critical technology is manufactured in the U.S. And then NVIDIA recently took a $5 billion stake and bought 4 to 5% of the company. And basically, they want to maintain manufacturing in the U.S. and integrate their GPUs with CPUs and develop new products. So we finally have a situation where Intel, which their earnings have been declining for years, finally has pretty big catalyst events happening. And this week on Monday, I brought this name to the team as potentially a new idea breaking out of a long base. And we like to buy these on pullbacks after the big gap. And that big gap day was the NVIDIA announcement. It pulled back for 3-4 days and found its footing, and it's had tremendous relative strength this week. And on the month, it is now up 46% this month. So this is the first name that I want to bring to your attention as potentially a new stage 2 uptrend with government and NVIDIA catalyst. The second stock that I want to talk about is Alibaba. And this stock is up about 27% this month. So, what caused this big breakout in Alibaba? Well, they had earnings, and we saw a nice earnings gap. And at that point, they announced that they are developing a new AI chip. So we have a new factor here, which is what we like to see in CAN-SLIM investing. This was followed up by news that the Chinese government is restricting major technology companies from purchasing NVIDIA processors due to safety, and basically this now leaves Alibaba and Huawei as the two main companies that are going to be producing AI chips for the Chinese market. Okay. So this was followed up also by news on Wednesday where NVIDIA and Alibaba announced a partnership, and that topped the stock in the meantime. But this is really just breaking out of a multi-year base and still well below its all-time highs. So again, we find a lot of winners out of the monthly leaders, and they can go on to perform very well and have multiple months of gains. So this is still relatively early in the breakout, obviously extended right now in the short term. However, it's a name that we should all have our eyes on. And as a matter of fact, Turbo has a position in it, and so does Toddzilla. So let's finally go to the third one. And this is the second blast from the past, called CIEN. CIEN is up 50% on the month and still below its 2000 and 1999 highs. And it spent several years just meandering around. However, finally, in this last quarter's earnings report, they had a huge report, and it finally took off, and it's been showing tremendous relative strength ever since. So this one does have very strong earnings and sales growth and meets the CAN-SLIM characteristics. But even in a down and weak market, this stock is making new all-time highs on the week. So that's all I want to say, but these are three names to keep an eye on from this month's monster leaders.
Yeah, Sienna and Intel, I remember those from back at the turn of the century in the internet bubble. And BABA, a huge pullback from its all-time highs, but as you mentioned, Todd, the N in CAN-SLIM, always something that we look for. Some new product service that's changing the way we work, live, or play, and in this case, tied to the AI theme that is certainly not going away anytime soon. Guys, thanks for your presentations. Let's take one more look back at the S&P 500 before we close. And off of its highs of the day, gapped up on some inline PCE, that is inflation data. But if we go to an intraday chart here, reversed and gave up quite a bit of that gap. But let's go back right here, and this was the FOMC. You can see the volatility before that. We ran up right near the 6,700 level on the S&P. This is looking a little bit like a head and shoulders, but yeah, bouncing back over. And one more presentation for you. Going to turn it over to Ted now, and he's going to take control of the screen before we close, and take it away, Ted.
Yeah, thanks, Don. So for this segment, I wanted to review two previous stocks and then two current ones that we actually own in Turbo. So I recently reviewed some of the biggest trades I've had in my career, and I noticed a similar pattern, and I want to call it setup progression. And it really happens for every single big winner that I've really studied. And really, almost all of them start with earnings, news, some sort of macro catalyst. And then you sometimes get an opportunity to add shortly after that catalyst. Eventually it gets extended and needs to pull back, and you'll see the high type flags. And afterwards, after the high type flag triggers, the stock is well extended from the initial catalyst, and then it needs a multi-month base before another continuation move. So SMCI, we had this early 2024, and it started off with this earnings surprise here. It gapped up 28% on earnings, but didn't see immediate follow through. Right afterwards, it presented you this super, super tight earnings continuation play. And so that is the second setup that you can potentially take after the initial catalyst. From there, you moved about 88%, and you don't want to chase extended stocks, especially post catalyst. That just gets you prone to withstanding a pullback and getting stopped out before the stock makes a new high. But you just want to wait for the next setup in the progression of setups, which is the high type flag. This is what you saw here at SMCI. Made a 200% move, corrected no more than 20%, and gave you another setup for a trade. Afterwards, since the catalyst and the high type flag, it made about a 225% move. And at some point, some market players decide stock's too expensive for them, it's too extended, so they start taking profits, or just get hit with some negative news that leads to new basing. So for the next 6 months, SMCI went sideways and chopped around, and eventually it saw another earnings catalyst or pre-released earnings, and that led to a 6-month plus base breakout, which then led to another 250% plus move. Some of these multi-month base breakouts can just be purely a function of supply and demand, but oftentimes it's paired with a catalyst, and those are often usually the best. So second example from the past, in late 2024, you see this exact setup progression take place. And this name is Rocket Lab. It started off again with an earnings catalyst, and I just label it as EP. For the next 3 days, it consolidated sideways, and you got that first earnings continuation or EP continuation opportunity. It ran up again, pulled back, and you got the second earnings continuation opportunity. Eventually, like I said, it runs up quite a bit, under 35%, and then it bases sideways for 2 weeks, no more than 15% correction, which is extraordinarily tight and presents you that high tight flag opportunity. Then it runs up another 100%. And then, like I said before, it meets supply sellers that think the stock is overvalued or overextended, depending on what methodology that market participant has in the markets. And that led to this multi-month base, which lasted about 6 months as well. Eventually, either earnings or just the market dynamics, supply and demand work itself out, and you have this multi-month breakout once again, and Rocket Lab is on to the move. Right now, it's potentially looking to break the 50-day. So those are two past stocks seeing the setup regression. Now I'm going to go to NP, which is currently owned in Turbo, seen some volatility in the last few days. But once again, earnings, this is triggered by the Department of Defense public-private partnership with MP that led to this gap out of this big base. This earning continuation setup was shortly after. So previously, like in SMCI and Rocket Lab, you saw more of a built-out flag. This entry tactic here would just be one of those simple either buy it off the pullback of the high volume close, or you buy it through the gap day's highs. And so that was the opportunity right there. If you did take that, you got lucky, and MP announced a second partnership with Apple, and that led to a 20% gap. Eventually, it ran up for a little bit, started basing sideways, and it presented, again, the third setup of the progression, the high tight flag. For this one, the high tight flag setup sort of faltered quite quickly. It went up 25% and then pulled all the way back to your entry. So you're either likely stopped out or under tremendous pressure. And now currently it's building a multi-month base. So I just have some question marks there. We don't know if this is going to just break down and fill, or eventually maybe we get another catalyst or just price breaking out of the space over 82.5, and we're off to new highs. Finally, another stock owned in Turbo, seeing the exact same setup progression, is LEU. We didn't take it on the earning. I mean, not earnings. This is triggered by Trump's executive order to develop nuclear capabilities in the United States. It gapped up on this day on huge volume. This is the day we did take it. It came out of this flag, and I'm calling it an EP continuation as a second setup in the progression of setups. And this led to a decent sized move, about 50%. Eventually, it pulled back again, found support at the 8 and 21, and it built a high tight flag. So this is the third setup in the progression of setups. This gave you a decent trade as well, 35%. But again, meets supply, it's extended. Some people think it's overvalued if they are fundamentalists, and that led to this multi-month base. Went through one earnings report, saw an undercut reclaim of this 193 level, and then it built this extremely tight pivot, which then we added back and have caught this move so far. And we've seen this multi-month base breakout. So those are 4 names. And actually, I just want to quickly talk about Todd's situation with Intel. We had the news with the NVIDIA partnership. That would be the gap day. Then it pulled back 3 days, and this gave you the earnings continuation setup. For this, though, if you bought the gap day, you would have gotten stopped. So then you'd have to re-enter on the the news continuation setup, and that's giving you a good move so far. I would think if this is a true move and it's extremely powerful, this could lead to some sort of high tight flag, potentially up in this 50 area. If it finds some resistance against previous supply, maybe up here, like in this 45 to 50 area. And then eventually, if it gets too extended, I could foresee some sort of multi-month base as well in the 50s and 60s. So that is a characteristic that I noticed in some of my biggest winners that actually trend, not just the few day big pushes that just falter and fail, but the ones that go for extended moves, somewhere between the lines of 6 months to 18 months, which is typical for a market leader.
All right. I almost wrapped it up before letting you do your segment there, Ted. All right. So I am going to turn it over to the ghost of Dan to wrap things up. And we appreciate all your support on social media. We appreciate every one of our clients and followers. And with that, we'll wrap it. All right. Thanks, Don. If you like what you heard, tell your friends, tell your neighbors, go to revereasset.com, give us a shout. Remember, it's your money, not their money. And with that, I'll wrap it. Thanks, everybody. It's not how much you make in the market, it's about how much you